It was a tough journey going from an intern to a senior professional. Now, to protect my savings against high inflation and grow my wealth, I invest in bonds with INR Bonds. Download the INR Bonds app to save better.
Hi, welcome to Let's Talk Bonds, the weekly podcast from INR Bonds. I'm Arjun Patsati. And in this week's podcast, I'm going to talk to you about whether you should invest in 3-year corporate bond yields, where the yields have gone up to closer to 8% for many very good issuers or well known names. Just before that, what's Let's Talk Bonds? Let's Talk Bonds is a weekly podcast where I talk about all the fixed income options available for investors and for financial advisors to recommend to their clients the best bonds to invest in various points of time. And the last couple of years, we have seen interest rates have been falling, and then inflation has risen, then interest rates have risen, causing a lot of issues to investors who have invested in fixed income products, and the returns have been extremely low. So let's talk bonds tries to give you guide investors and financial advisors to the best investments available in the market given various economic environments. Now coming back to the current podcast, 3-year corporate bond yields have risen from below 6.5% to closer to 8% over the last 1 year. And that's because overall the government bond yields have also gone up. So GSEC yields have gone up to 7%, while state development loans are trading for 3 years, are trading at closer to 7.4%. The Bharat Bond ETF, which is an index of PSU bonds, are trading at around 7.25%. Now, all well-known names are now trading at much higher levels, over 7.5%. And a lot of private placements have been happening on the 3-year front. You have Cholamandalam Investments issuing 3-year bonds at 7.9%. Fullerton issuing 3-year bonds at 7.95%. LIC Housing Finance issuing 3-year bonds at 7.9%. All these have been very steady names across the years. You have NABARD that is coming out with 3-year bonds at over 7.3%, which is again good given that it's a PSU and an Apex bank. It is a very good level for that particular bond, given that the same bond was trading at below 6% just a year back. So investors are seeing a lot of options now available for investments at the 3-year front. The question is, should you invest in this bonds? Clearly, a couple of things are happening. One is there is a weakening rupee, and when the rupee weakens typically and goes to a free fall, the central bank looks to raise interest rates very sharply at the short term and also cut down all the money in the system so that inflation has come down and the rupee can be protected through higher short-term interest rates. And if this happens, then there can be more pain for 3-year bonds. But having said that, if investors are comfortable with higher levels of yields and around 7.5 to 8% for 3-year maturity bonds, and because after one year, the same 3-year bond will become 2 year bond, and after 2 years, it will become 1-year bond, and hence it will be priced accordingly. And even if they have to sell it to gain liquidity, they may not have to sell it at a lower, higher yield where there's capital loss. Hence, 3-year bonds are sounding attractive for investors. And the best place to look at 3 years bonds for investments is the Quick Invest INR Bonds app available on iOS and Android, where we list all the best bonds available for investors. We rate the risk and we give the most information on these bonds and the highest transparency in prices and the best in-app investment process. Download the app now. And coming back to the other placements happening in the market, significant ones is Vedanta is showing 10-year bonds at closer to 8.5%. And Vedanta has been going through a tough time with commodity prices falling there recently. And this could impact the company. debt as well. 10-year bond at 8.74% for Vedanta. Uh, Thank you for listening in to Let's Talk Bonds. Do send in your comments and do follow us on all the podcast channels from Apple Podcast, Spotify, Amazon Music, and YouTube. And do not forget to subscribe to our podcast.